So the Fed raised rates 25 yesterday and is threatening in September to raise another 25 basis points. But this is sort of at the end. One of the things you can sort of read into the whole Q&A and the whole statement from the Fed is they feel like they're winning the game. In fact, I would argue the Fed feels like they've beaten inflation back. They have a line of sight on some sort of that 2% inflation. They may be a few months or maybe even a year behind the pace, but they're on the right track. So this is a confident Fed. And this is a Fed that feels like, you know what we want to do for these at this stage? We don't want the bond market to try to rally here. We don't want a big interest rate rally anticipating cuts even in 2024, mostly because the Fed says we're on the right track, so we're on the green run in terms of decline inflation. We want to make sure, though, that financial conditions for companies and individuals don't get easier here. We want to keep them tight and see if in 12 months we're back to trend on inflation. So I think this is a Fed that really is going to keep the bond market, try to keep the bond market from going for a rally, which is to say future rate hikes, maybe as much as anything else, be designed to stop us from pricing in rate cuts in 2024. And Chair Powell said as much, said maybe the first rate cuts won't be to 2025. That was his way of pushing the bond market, saying don't let the futures market rally, don't price in any bond cuts at all anytime soon. Keep these rates where they are. Our portfolio is got a lot of yield, has a lot of yield in it right now, and we've actually taken a very diversified approach. We actually feel like this is the anti-08. We've talked about that in the past. We feel like that the calls for a deep recession have been a little bit sort of premature. That may happen later, but not yet. And so for us, we have a nice balance of still having lots of high yield and bank loans, but leaving lots of room to add in case something breaks in the economy. And usually something does break. And at the same time, we've added a lot more duration in the sense that we've moved the interest rate sensitivity of the portfolio in the last 12 months from really low interest rate sensitivity, short duration, to now having a bit of a long duration feel, but really focused on 5 to 10 year part of the yield curve, that middle part of the yield curve, which we think will benefit, one, the most from a reshaping of the yield curve from inverted to steeper. We think that'll happen at some point. And at the same time, that 5 to 10 year part of the curve provides us with great ballast just in case the Fed does break something and the bond market has to reprice pretty quickly.